Welcome back to the Schwab Network. We got a better looking pre-market session so far. Stocks are up, risk is on, bonds are calm, dollars down. We do have a very busy day ahead with Fed speakers. Joining us now, Liz Ann Sonders, as we think about the next 48 hours with jobs on Friday, too. She's the Chief Investment Strategist at Charles Schwab. Good morning, Liz Ann. We're on the morning shift now. We had a good conversation, you and I, with Kathy yesterday afternoon. Kind of about the big themes here is the stock market seemed to be paying more attention to bonds, but after yesterday, is this week kind of like a wash in terms of data, what it means for bonds and stocks?
Yeah, I do think it puts bonds and then related stocks in yet again another wait and see mode because you did have conflicting data throughout the week. I think the focus that has eased some concerns about an overheating economy has been on although improvement in ISM manufacturing, which is actually a good thing given that that had been in recession territory, the move down in ISM services, still in expansion territory, but a move down more than what was expected and a big move down in the prices paid component. And then you got the claims data out today, which showed more of an uptick than what was expected. So I think it calms some fears of overheating, but the big one is obviously tomorrow morning at 8:30.
Give us the kind of under the hood look at the connection between the prices paid in an ISM print versus the inflation figures, because we just came off 2 months of warmer than expected inflation. Can an ISM prices paid like overrule what we just saw for the core inflation data?
Not necessarily. And then one of the rubs to what was shown in the ISM is that ISM goods prices paid has hooked back higher. So what we continue to see, as we've been talking about for a couple of years, is sort of this roll through. You had a roll through of individual sectoral recessions with manufacturing and housing, and you have now maybe in recovery mode there. You saw it from hyperinflation on the goods side to disinflation to deflation and now a hook back up. But services has been more of the trouble spot within inflation and what's been stickier. So all else equal, a little bit of a retreat there, at least what's picked up by the ISM survey is somewhat healthy. But again, we're still in this cross currents mode. And to your point, Oliver, that means that whether it's expectations around Fed policy or what the next CPR, PPR report's going to look like, what the next jobs report is going to look like, and expectations for not just the start point for the Fed, but the pace at which they cut is still a moving target and can change on a day-to-day basis.
Okay. There's the chart of the ISM components drifting lower from the highs, but for the most part been kind of stable. We can kind of see where some of the gyrations have been to the downside, but at least it's holding on. We've got the services part of our economy still humming generally. If we combine a manufacturing, you come back as well as kind of a bounce back in factory orders this week too. I mean, generally positive on net still the information we got this week, encouraging.
Well, yeah, positive on net, but also the explanation for why leadership has resided in areas like energy and materials and industrials this year. And fortunately for us, as you know, Oliver, we launched sector views or relaunched sector views after a 2-year hiatus for a number of reasons. And the 3 sectors on which Schwab has outperform ratings are energy, materials, and financials. And they've all done quite well there. It's where the breadth breakouts have been, in addition to areas like industrials, a little bit more coming from utilities recently, but I think that was a lot of the rebalancing trade that occurred at the end of the quarter, and that had been such a laggard that I think the rebalancing money just gave some support. But really, it's been this cyclical trade, and that has to do with this pickup in manufacturing, some signs of life outside the United States, and that's been to the benefit of those traditional cyclicals.
Okay, and that's been an important development because it fits with the macro when sectors like that are leading, when commodities are rallying, no coincidence by any means. I mean, the commodity charts themselves are getting back to near 1-year highs depending on kind of how each basket is weighted. So one of the implications, I guess, would be the positive view on those sectors and kind of the other broad conversation we're having about whether or not the Fed's going to have to back off the desire to cut.
Yeah, no, I think that the market's no longer way over its skis like it was at the beginning of the year in terms of expecting a March start and 6 to 7 cuts. In fact, the market expectations have now essentially leapfrogged the Fed's dots plot and are expecting less than 2 cuts this year. But it's still, as I mentioned, it's still a moving target. Even a single, whether it's a labor market report or a CPI or a PPI report, can change those expectations. But seeing this continued roll through where even if services starts to get dented more than what we've already seen, the hope, of course, is that you have this offsetting strength on the manufacturing side. And again, the commodity strength is a sign of maybe some bottoming occurring in global indicators. And in addition, a lot of where you're seeing this budding strength within the economy is in areas like that sort of traditional CapEx and infrastructure projects, both on the private sector side of things and on the public sector side of things. And that has been to the benefit of commodities and related those more traditional cyclical sectors. Any significant deterioration in growth from here, obviously, I think would pose a risk to those cyclical sectors. And you might see investors snuggling back up to what this cycle's defensive stocks have been, those kind of mega cap, high cash flow, techie kind of stocks.
Yeah, we don't necessarily have to pick one or the other, right? I mean, there are scenarios in which we could get the recent leadership from more cyclical groups working alongside the overall momentum tech trade. But that's a scenario that's kind of like an ideal outcome, I guess, at this point.
Yeah, and it would. And I think in terms of figuring out what the true leadership trends are, we started a very important period here in the next several weeks, of course, which is first quarter earnings. And that had been where you saw incredible strength in support of some, clearly not all, of the magnificent stocks, the AI-related stocks. Now, I think in coming into clearer focus will be not just the earnings for the first quarter, but the outlooks from not only last year's darlings, but also seeing if it confirms the cyclical leadership that we have seen with an improved outlook for earnings among those key sectors.
Okay. Before we get to earnings, we've got jobs tomorrow. Liz Ann, what are you looking for? Is this really the most important number to kind of maybe break the tie on conflicting data for the week?
Probably, but then everybody's attention, once everybody digests the jobs report, will be to the upcoming CPI and PPI report. So I think we have a somewhat short attention span when it comes to the importance of these data points. But the expectation for payrolls is 215. There's some whisper numbers that are higher than that. I think important related to that is what the revisions look like for the prior month or two. That's been a big story. The response rate is down quite a bit relative to recent history for the establishment survey, which generates payrolls. And that means we've had pretty significant revisions, for the most part, downward revisions to the prior month. So you've got to look past just whatever the headline reading is to look at what the revisions are and net them out, because that tells a more accurate picture. And then the establishment survey generates payrolls, and you have the household survey from which the unemployment rate is calculated. The unemployment rate, I think the consensus is an expectation to go from 3.9 to 3.8. Obviously, move in the opposite direction would raise some concerns, because then it starts to come closer to breaching the so-called SOM rule, which has historically been kind of a perfect indicator of recession. We already have 21 states that have hit that threshold, so that will be important. And then, of course, as it relates to things like inflation, average hourly earnings, hours worked, some of the innards of the report, I think, are just as important, and the labor force participation rate as well.
To come back to that, Liz Ann, real quick, how close are we on the national threshold to triggering that SOM rule?
I think if we got a tick up in the unemployment rate tomorrow, we may hit it.
Okay.
Off the top of my head, I'm not sure if it would be to 4, but we're getting close. And as I mentioned, 21 out of 50 states have it triggered at the state level.
So yeah, we're at the point where it could at any moment essentially be triggered if there is an imperfection or things.
Or getting very close.
Yeah. Okay. All right. Great stuff. Thank you very much, Liz Ann Sonders.
Thanks, Oliver.
Fantastic. Appreciate it. as always, really good look here at the potential for leadership changes within the equity market and how to think about tomorrow's number in relation to the data we got this week that have been kind of conflicting.